Global stock markets ended Thursday in the mixed territory as the investors balanced the renewed pressure on the United States technology stocks, broad losses across the Latin America, and the caution in the trading in both the United States and Europe and Asia, with the volatility indicators flashing the signs of the nervousness over the monetary policy, the economic growth, and the geopolitical risk. In the United States, the Dow Jones Industrial Average barely managed to stay in the positive territory, rising just 0.02% to close at 44,922.27, supported by the defensive blue chip names, but the broader tone was negative as the S&P 500 fell 0.59% to 6,411. Also dragged down by the weakness in the technology, the consumer, discretionary, and the cyclical sector. The Nasdaq Composite heavily weighed towards the mega-cap tech stocks that have powered much of this year's rally, slumped 1.46% to 21,300 as the profit-taking hit high-growth name amid the concerns that valuation may be stretched in a higher for longer interest rate environment. Also, the Russell 2000, which tracks the United States small cap companies, also underperformed with a 0.78% decline to 2,276, reflecting the broader pressure on the domestic oriented firms that are more sensitive to the credit condition and the consumer spending. Also, investors' caution was further reflected in the CBOE volatility index, that is VIX, widely seen as the Wall Street's fear gauge, which jumped nearly 4% to 15.57, underscoring the rising demand for the downside protection as traders prepared for upcoming inflation data and commentary from the Federal Reserve's official. The market strategist noted that while the corporate earnings have so far been resilient, concerns persistent that sticky inflation and a strong labor market could force the Fed to delay the rate cuts, potentially capping the equities gains after a strong first half of the year. The north of the border, the Canadian equity tracked the United States lower, weighed down by the weakness in the commodity-linked sectors. Also, the S&P TSX Composite Index fell 0.35% to 27,823.88, while the S&P TSX 60, which focuses on the large cap Canadian firms, slipped 0.15% to 1,652.51. Analysts pointed to decline in the energy and mining shares, reflecting the softer crude oil and copper prices as the key drivers of the day's losses. Also, market participants highlighted that Canada's resource-heavy equity market also remains highly sensitive to the swings in the global commodity demand, particularly from the China, where ongoing property sector troubles have curbed the industrial activity and weighed on the medical processes. The global commodities market also were subdued on the Thursday and the other time, with the major energy, metals, and agricultural contracts showing that of the little movement as the traders remained cautious ahead of the fresh economic data and the central bank signals. In the energy space, the West Texas Intermediate, that is the WTI crude oil, the CLOO, the settled of the exchange at the $61.77 per barrel, holding near the lower end of its 52-week range of $52.12 to $79.39. Similarly, the Brent crude oil, the international benchmark, was also flat at $64.91 per barrel, also trending closer to the bottom of its year-long range of $58.39. Also, to $82.93. The markets analysts have also noted that the oil prices have been under pressure from the concerns about slowing the global demand, particularly from China, coupled with the steady supply from the OPEC plus producers. At the same time, the geopolitical risk in the Middle East and the shipping disruptions have offered a degree of support, keeping the crude oil from sliding deeper into the bear market territory. The traders are closely watching the upcoming inventories reports and the demand forecast from the International Energy Agency and the OPEC, which could also provide clear direction for the market. The natural gas fortune also saw no movement, holding steady at $2.77 per billion British thermal meter, and also the prices that have been ranging bound that of between $2.02 and $4.93 over the past year, reflecting the seasonal swings in the consumption as well as shift in the LNG exports. While the inventories remain healthy in the United States after a mild winter, the demand prospect for the second half of the year are expected to hinge on the summer heat wave and export trends to the Europe and Asia, where the natural gas continues to play a crucial role in replacing the Russian supplies. In the precious metal complex, both the gold and the silver were stable. The spot gold was exchanged and also the price, that is the $3,358 per ounce, holding the close that of the record highs within the 52-week range, the band of the $2,500 to $3,500. The yellow metal has benefited in the recent months from the strong safe haven demand as the investors hedge against the economic uncertainty, currency volatility, and the geopolitical tensions. Silver likewise traded the flat at the $37 per ounce, remaining near the upper end of the year-long range of the $27 to $29.91. Analysts suggest that while gold is largely being driven by the central bank purchases and investor hedging, silver is increasingly tied to industrial demand from the solar panel production and the electronic manufacturing, adding a cyclical component to its price action. In the agriculture, the soya beans were one of the few actively traded contracts showing movement, slipping 0.05% to $10.33 per bushel on the heavy trading volume of 113,000 contracts. The oilseed has been trading between the $9.45 and $10.82 often over the past year, with the weather conditions in the South America and the United States planting prospect serving as the key drivers of the supply expectation. Analysts noted that concerns over the crop yield in the Brazil and Argentina, coupled with fluctuating demands from the China, continue to inject volatility and soya bean market. Overall, the commodity market are a period of consolidation, with the prices moving sideways as investors weigh global economic growth risk, geopolitical uncertainty, and the outlook for the interest rates. Energy benchmark remains subdued despite the supply concerns. Precious metals are holding near historically high levels as the safe haven assets and the agricultural products remain heavily influenced by the weather and the trade dynamics. Traders are expected to stay cautious in the near term, with the upcoming economic data and the central bank commentary likely to determine whether the commodities break out of their current holding patterns are true.